Well, hello. Welcome to the OneAZ Wealth webinar on understanding your rollover options and retirement income strategies. My name is Tom Mitchell, and I have the honor of leading the OneAZ Wealth Management team of wealth advisors located here at the OneAZ Credit Union. Our full-time professional financial advisors are assisting clients and members of the OneAZ Credit Union all over the great state of Arizona. We're very excited to bring you these educational topics to you because it's you who actually created them and have suggested them. So again, I ask everybody on this call right now, as you can, please email in new topics because we do listen to your topic suggestions and that helps build out our calendar. So much so that we actually have several more events coming up. First of all, this webinar event that we're doing tonight is actually going to be repeated. This webinar on rollover options is going to be repeated on June the 20th at noontime and also on August the 17th at 5:30. We've gotten so much popular demand for this topic, we're doing it 3 times. So if you don't catch everything tonight, you want to come back, certainly you'll have to come back and register again for a new registration that's on our website, or you can tell family and friends about it and have them join us either on June the 20th or August the 17th. As far as new topics, actually in July the 11th, we're actually going to be doing a webinar on cybersecurity. It was a very popular topic about 2 years ago, and we're bringing it back. So we're excited to bring you that. That's going to be on July the 11th on all the cybersecurity issues and how to protect yourself from identity theft, etc. And then again in August, though, we're going to do a second webinar in August, but it's going to be tailored for business owners. So if you're a business owner and on the call, you'll want to come in and listen to that webinar because we're going to talk about how you can help maximize your business succession planning, actually how to value your business. We'll touch on that a little bit. So a lot of good information we're going to touch on that webinar, but that's at the end of August the 29th. All right, first, here's our informational page. It contains all of our required legal disclosures for your convenience. But please, I ask you to check out our oneazwealth.com website for upcoming webinar events that we have scheduled throughout the whole year. For better audio, this webinar is going to be in listen-only mode, and we will be fielding your questions at the end of the webinar. Please email your questions in to oneazwealth@oneazcu.com. We have been compiling the questions that have come in. We actually have over 20 questions already. So we've got a lot of questions to answer for tonight, but please email any additional questions in, and we promise if we don't get it to tonight, we will get back to you directly when answering any of your questions. Again, lastly, for more information about OneAZ Wealth Management and the team of advisors, I urge you again to visit our website. Actually, if you have your mobile phone, you can use your phone and actually scan the QR code that's on the screen right now, and you'll be able to pull up lots of information and make contact with us. I also, again, urge you to connect with us on social media. We have a Facebook page as well as LinkedIn and YouTube, and where we share more resources and information on other topics. So please connect with us. So let's get started. First of all, OneAZ Wealth topic again is understanding your rollover options and a little bit about retirement income strategies. What I've done is I've asked Mike Sammons, one of our senior wealth advisors, to join me tonight. Mike, are you there?
Yes, Tom, thank you.
Excellent. Well, let me just tell you a little bit about Mike. Mike's going to be joining us on a few slides a little later. But Mike actually is a true veteran in this industry, 32 years of experience helping families and individuals pursue their long-term financial goals. Mike began his financial career at Merrill Lynch back in 1991, and he joined the OneAZ Credit Union in 2004. So that's 19 years ago, almost 20 years. He actually completed extensive training and earned the Chartered Retirement Planning Counselor, the CRPC designation, back in actually 2011. And he's originally from Chicago, but now calls Arizona home. But when he was in the Midwest, he actually got his bachelor's degree in finance from the University of Iowa. And and Mike is fully licensed in all of the insurance lines and securities that is needed. So he's fully equipped and lots of great years of experience. So again, I want to say welcome to all of us on this webinar for joining, and because we're going to talk about the choices of retirement account rollovers and the different consequences of those decisions that you have. As we look to create a presentation, we discovered actually one of our product partners, CUNA Mutual, actually had already created a very nice PowerPoint that lined up with exactly what we wanted to present. So I want to say thank you, CUNA, for allowing us to share these slides with you tonight. So OneAZ Credit Union and the Wealth Management team is committed to bring members and clients financial education. We know you need to have good education in order to have good financial decision making. So this presentation is intended to be solely educational and informational. While this information is universal in content, I know that we also have several individuals from the OneAZ Credit Union, and we've invited them to this presentation because they actually have a pension plan that is in the termination process currently. I will have a couple slides that are very specific to the OneAZ Credit Union folks at the end of today's presentation. So be patient, we'll get to those slides. But again, all of the information we're sharing tonight is universal and similar to no matter what your current status is. All right, this is the CUNA Mutual disclosure for compliance purposes, but I also want to make everyone know that this presentation is being recorded, and we will have it posted on our website as well as the slides, and that will be posted to the oneazwealth.com website, and I'm hoping the posting will be done in about 5 to 7 days. So be patient and look forward to that. All right, again, I want to highlight our commitment to you. Today's session is focused on providing valuable education about your options for moving your retirement plan, for you that you have in moving your retirement plan assets when you leave retirement, whether you leave retirement by retiring or by simply moving to a new career with another firm, another company. We will review those options that are available to you. We also want to compare and call out those pros and cons of those different options. So it's so important for you to understand what they are. You spent a lot of your career building assets in your retirement accounts, as well as knowing that those are for retirement. You want to make good decisions and informed decisions. So again, that's why we're presenting this presentation. And many times you also need to have alongside with you a good advisor, a wealth advisor, a financial advisor. Some of you may already have a financial advisor. That's great. And I encourage you to reach and seek their counsel. If you don't have an advisor, I urge you to reach out to even us at OneAZ Wealth. We're here ready, willing, and able to help you and to assist you and guide you through these decisions that you'll be making. But again, it's very important to seek good counsel and making sure you understand all the facts. So as we turn this up, before I turn this over to Mike, I wanted to call out a couple of things that I did some research on and found some interesting things. I found out the median tenure amongst American employees that are between the age of 55 and 64, the average median tenure of employment is about 9 years, almost 10 years. But if we look at all Americans, the actual median average of tenureship of employment again is about 4 years. So about 4.3 for men and about 3.8 for women. So think about that for a moment. Every 4 years, on average, an American is making a change in their employment. That means that every 4 years, this retirement decisions, some of the concepts that we're going to share tonight are going to be they're going to have to deal with them every 4 years as they look to new careers and new decisions to what to do with their retirement funds that they've been accumulating. So that's why it's so critically important. I think that's why this has become such a popular topic. Now, if we did some math here, let's do some math. We've got about 130 million full-time workers in the United States right now. And if 80% of them that have for this full-time workers in these different private industry or state and local governments, they actually have access to retirement benefits, about 81% of them. So if I did 80% or 81% of that 130 million employees that are out there, that represents about 100 million people. But then there's about 82% that actually do participate and actually participate and save in their retirement plans. So if we do the math on that 100 million, that brings it down to about 80 million. So we have about 80 million people out there that are in retirement plans that are participating. Now let's use the math again on those prior slides. Every 4 years, someone's going to have to make a change. So about 1/4 of the 80 million, wow, that's 20 million people a year are having to make decisions on what to do with their retirement monies as they move forward in their careers. So that's why, again, it's so critically important to understand the pros and the cons of all the choices that you have. So let's kind of get started. I'm going to turn this over to Mike. Mike, why don't you go from here?
All right, thank you, Tom. Not everybody makes the same decision, but it's important to know the consequences of your choices. You usually have 4 options. Option 1, you can leave your money where it is. Option 2, you can move it to your new plan. Option 3, you can convert it to cash. Or option 4, you can roll it over to an IRA. Let's take a closer look at each option. Option 1, leave your previous retirement plan with the old plan administrator. It may feel easiest to do nothing when you terminate employment and leave your assets in your old employer's plan. This option also might involve much lower fees than some of your other options, but it comes with some downsides and limitations. So, and as you can see here, some of the pros are there's no taxes or IRS withdrawal penalties if you leave it where it is. The tax-deferred compounding continues. You have access to investment options like company stock. The fees may be lower. And there's this IRS rule of 55, which I'll just talk about in a second here. Some of the cons are going to be the limited investment choices. Keeping track can be tough if you keep changing jobs often. Your access is controlled by the plan, and you may not be allowed to continue contributing or to take loans. So the rule of 55, one important rule to keep in mind for those 55 and over is what's referred to as the rule of 55. It is an exception to the IRS rules governing distributions that allows you to withdraw the funds from an employer's plan if you leave that employer during the calendar year you turn 55 or any year after that. So what it says, the rule of 55 says if you leave your job for any reason, you're retired, you're fired, a career change, during the calendar year you turn 55, you can access your retirement funds without the 10% penalty. Currently, the retirement age is 59 and a half years old. You can wait, once you turn 59 and a half years old, you can take the money out without that 10% penalty. So what this is doing, it's allowing you to get access without that 10% penalty 4.5 years earlier. But it only applies to funds in the plan with your current employer, not previous employer plans. Fees can have a significant impact on the final balance of your retirement account. A difference of just 1% on an account starting at $100,000 and earning only 4% annually over 25 years could result in $32,000 in fees alone. Many employees aren't aware that their employer-sponsored retirement plans have these fees. Some typical fees are administration fees. There's investment fees such as management fees. There could be commissions or sales charges, possibly advisory fees. Then there's also what they call individual service fees. Fees can vary widely, but they don't necessarily correlate with better performance. So do you know what your 401k fees add up to? I would guess most people do not. Option 2, you can move your previous employer plan assets to your new employer's plan. if your new employer may allow you to move your retirement savings into their plan. If so, that's an option for you to consider. But not all employer plans will accept rollovers from previous employers' plans, so it's not always an option. You'd first need to contact your new employer's plan administrator to find out whether it is an option and then how to proceed. Transferring your savings to a new employer's plan allows your assets to continue compounding tax deferred. But there are some important details to be aware of. If you choose a direct rollover, you avoid current income taxes and the 20% mandatory withholding. There are no tax consequences for that year. If you choose an indirect rollover, the check comes directly to you and you need to deposit your distribution, including the 20% withheld, within 60 days. That means you need to get the 20% that was withheld from somewhere else because the IRS is going to hold it against possible tax liabilities. So for example, if you have a $100,000 401k plan and you take an indirect rollover, they're going to send you $80,000 and withhold 20% or $20,000. If you decide later, I want to roll it over to an IRA or another employer's plan, you have 60 days to do that, but you're going to need to come up with that $20,000 that they withheld to make it a whole $100,000 again. So there are pros and cons. Rolling assets into your new employer's plan puts all your money in one place, and your new plan may have attractive investment options or loan features that you may want as well. However, there are cons. At the same time, your investment choices are then limited to whatever the new plan offers. The same goes for withdrawals, exchanges among investments, and emergency access to your money. Everything is subject to the rules for the new plan, and distribution options before age 59 and a half could come with a 10% penalty. And that's all if you have access to a new plan. If you're now working part-time or maybe independently or freelancing, or you start your own business, you may not even have a plan to consider to roll over. So in that case, there are other options for you. Option 3, you can convert your employer plan to cash. Cashing out your plans puts the money in your pocket, no restrictions. However, that is rarely the best choice when considering your financial security. There are a few major drawbacks to be aware of. A lump sum distribution may seem like a simple and appealing option, especially if your account balance seems low to you. You may think it doesn't make that big of a difference in the long run. Why bother? So you do have immediate, unrestricted access to your money, and all that cash can be enticing. But cashing out can cost more than you might think. You know, distributions may be subject to significant penalties and taxes. The dollars that can only be rolled over into another employer plan or IRA, if done so within 60 days, and taking the cash and spending it now can throw your future retirement plans way off course. So it's not the ideal situation. And cashing out has a costly side that everyone should be made aware of. Cashing out or taking an early distribution makes your money subject to penalties and taxes, and that take a big bite out of your total distribution. So 20% of the distribution is required to be withheld to pay taxes. Your distribution is also subject to federal and state income tax at the current tax rate. So that could add up to a very big loss. Let's take an example. Let's take a look at an example of that shows the immediate cost of cashing out. So what happens when you cash out? First, you can count on federal and state income taxes on your distribution. On top of that, lump sum retirement plan distributions before the age of 59 and a half are often subject to an additional 10% tax penalty. So total taxes and penalties can add up to as much as half of your account balance. Plus, after 60 days, the money withdrawn can no longer be moved into an employer plan or an IRA, so that tax deferred status is now lost. So in the example they're showing, that $40,000 that you cashed out may only come out to about $26,400, where if you just roll it over to an IRA or another employer plan, you would receive the full $40,000. And what a lot of people will do is roll it over into an IRA. You still have access to the funds, and then you control when you pay taxes by making distributions at, when it's convenient for you, instead of taking it all at once. So there's a lot to lose, right? Well, there's more. When you cash out, you opt out of allowing those assets to continue accumulating and growing your retirement savings. And those longer-term losses can be staggering to reaching your retirement goal. So you want to try to stay invested as long as possible. When it comes to retirement investing, you want to keep time on your side. Taking an early distribution eliminates your assets' potential for compounding. It is a mistake to underestimate the value of time, especially if you're early in your career or you're young. You want to keep that money continuing to grow. There's a simple rule called the rule of 72 that determines how your money will grow in tax-deferred accounts like IRAs and 401ks. So for example, say you're earning 8% on your money. You divide 72 by that rate of 8%, and that answer 9 is the number of years it takes for your money to double. So if you're only earning 2% on your money, 2 goes into 72 36 times. It would take 36 years for your money to double. So let's take a quick look at the potential difference in outcomes between cashing out and staying invested by choosing a rollover option. So the first investor rolled over that $40,000 and didn't contribute another penny over the 25 years that followed. So over 25 years, that $40,000, assuming a hypothetical return of 8%, would grow to $295,000. The second investor tried playing catch up. They cashed out and then contributed $4,000 a year, or $333.33 in monthly contributions over 25 years, and barely outperformed what they would have earned by just investing the $40,000 initially. The first investor that contributed $40,000 ended up with only a little less than the second investor, who contributed a total of $100,000. So the difference was about $25,000, but the second person invested $60,000 more of their money. The third investor did both. They rolled over the $40,000 and contributed to an additional $100,000 over 25 years. The third investor's money is about double what the other investors earned over the same 24 to 25 years. This is why you cannot make up for lost time. So if you can, the best possible scenario would be to leave the money in and let it continue to grow. Even if you can't contribute to it, you should do just as well as the person that put $100,000 in over the 25 years. Option 4, you can roll over your previous employer plans to an IRA. A rollover IRA can allow you to consolidate your retirement assets. Maybe you have multiple accounts from old employers that have been sitting around, you haven't touched them in a while. Well, you can work with an advisor, have your old plan, roll your old plans into one rollover IRA. And when you're working with an advisor, they can help you with avoiding taxes, penalties, keep you on track with your retirements. And basically all these accounts can be rolled over into just one rollover IRA. Most importantly, a rollover allows the savings you worked so hard to accumulate to continue to work hard for you. First, it keeps your assets invested so they can continue earning and compounding over time. Second, it may give you greater control over your investment choices and retirements down the road. But let's consider the pros and cons. A popular choice for people changing jobs and for retirees is a direct rollover of the employer plan assets to a traditional IRA. So when you roll over your retirement plan distribution, you typically don't pay taxes on it. So you preserve that tax deferred status and allow your assets to continue to grow. Some of the pros are it's easier to keep track and manage your records. You have a greater range of investment options. The assets can be converted to a Roth IRA if you'd like to do that at a later time. And you have an option to withdraw before age 59 and a half without the 10% penalties. So IRAs can provide an opportunity to withdraw funds penalty-free in the event of an early retirement, so before age 59 and a half, by taking substantially equal periodic payments. This is called a 72Q. There are some qualified retirement plans that offer similar options for taking early distributions, but many really do not. So you do have that option to take money early for taking an equal periodic payment. Inside of the IRA, there's a range of investment options that you can invest in when working with an advisor, such as money markets, certificates of deposits, which are CDs, stocks, bonds, annuities, mutual funds, managed funds. People ask me all the time, Mike, what are your IRAs paying? An IRA is not an investment. It's a type of an account. And depending on what you invest in your IRA will determine the rate it will grow. I've seen IRAs invested in gold, in real estate. People can invest in franchises with their IRAs, or 100% in one individual stock. Like I'm going to put all my money in Microsoft. In general, there are so many more investment options in an IRA than your typical employer-sponsored plan. Remember, fees do have effects on your account balance, and the difference of just 1% can make a big impact over the course of a lifetime. So when you work with an advisor, he or she has a commitment to ensure you understand the fees involved when you make investment decisions. That clarity can help you feel more confident in your choices. So what can't a rollover IRA do? Well, one downside is that you can't borrow from an IRA like you can from your 401k. So once you roll it over, you can take money out, but you can't borrow against it. And there are special tax advantages upon distribution for assets held in employer stock that an IRA cannot offer, that your employer-sponsored plans can. And while many states' law offers some protection from creditors when it comes to IRA assets, employers generally enjoy greater federal protections. Withdrawals after 59 and a half. You can dig into your 401k plan's administrative and investment fees. You may determine that you have better options for investments and better clarity and costs when you work with an advisor. If that's the case, you can consider taking advantage of what they call an in-service withdrawal after age 59 and a half. This is a great opportunity to move some or more of your or some of the money or part of your money from your 401k into an IRA, into investments that you prefer without incurring any additional penalties. So for example, if you are 60 years old and you're concerned about market fluctuation, you can do an in-service withdrawal and roll over your funds into an IRA, then invest in a CD or a fixed annuity, something that's not going to fluctuate with a fixed rate. Or if you want to invest in a specific investment, like you want to purchase stock in Netflix or buy gold for or any specific investment, for example, you can again roll over funds to an IRA and invest in whatever you're looking for. This is most plans will allow this, some do not, but it is something that I do see a lot of people take advantage of, once they're over that 59 and a half. Because again, inside most employer plans, you only have their options. You can't say, I want to buy Tesla stock with my 401k. unless you work for Tesla, they're probably not going to let you do that. So, with that being said, I'm gonna turn it over to Tom, and he's gonna talk about the distributions.
Sure. Thank you, Mike. You know, that in-service withdrawal is an area that is overlooked, and many times people just don't know about it. You just talked about that on that prior slide. People that are just in that brink of getting closer and closer to retirement, it's a way you can truly have things better balanced and better positioned for your long-term desires by simply moving some of those assets into your own personal IRA well before you retire, which is quite a nice benefit. But again, it all depends upon your 401k plan. All right, now let's talk about if you do roll over some of that retirement money into an IRA or rolling those assets over even into a new 401k. There's some things I really want to call out. We've touched on them a little bit already, but I'm going to spend a few minutes driving this home. There's two ways you do it. You do it either through a direct method or you do it through an indirect method. The indirect method, I like to make sure you understand there's a 60 days tie-in to the indirect method. So let's talk about it. First is the direct method. With a direct rollover, you don't handle the money at all. Your assets are actually, instead, they're transferred by the previous employer plan administrator to either your new plan, your new 401k plan, for example, or your own rollover IRA that you establish. Your previous plan administrator makes a payment to the new IRA or your new employer, again, directly. That's why they call it a direct rollover. In a direct rollover, there's no income taxes due at the time of the rollover. There's no requirement to withhold any 20% in taxes, and there's no 10% penalty for any early withdrawal. Your funds are also retained for that tax deferral status and may continue to grow in the new plan. You start the process by always contacting your prior administrator of your former employer in order to begin the process. That's how a direct program works. We urge and encourage that in most all cases. Occasionally, we actually do see this indirect. And sometimes there's some big pitfalls that people don't recognize and pay close attention to. But here, your previous plan administrator actually with an indirect rollover makes the payment to you. That means you actually take possession of the funds. Your previous plan administrator, again, sends the check to you with a 20% withholding in case you don't make that full deposit in your new plan. So the government takes their 20% right off the bat. So in order to have that fully executed, you need to add, as Mike earlier mentioned, you need to add 20% of money from your own pocket if you want to make this a complete and full rollover. He used the $100,000 example. Again, $100,000, if you take the indirect method, 20% or $20,000 is actually sent to the government. You only see a check for 80. So you need to add 20,000 to that 80 to make it 100,000 to complete a complete rollover. If in fact you don't, and you just roll over the 80, guess what? The 20% or the 20,000 that was sent to the government, that actually becomes taxable. You have to pay taxes. And if you're under 59 and a half, you pay a penalty. So please, I urge you and I ask you, please avoid the indirect method if you can, because you have to do it within 60 days. Because if you don't, you're out of luck. The government will call that and make it these penalties. So what are those penalties we talked about? The income tax must be paid in full on the distribution. Tax deferral status on the previous plan dollars after the 60 days, it's gone. All right. So you got to understand income taxes are a reality and the participant can no longer roll those assets. And there's an additional 10% penalty on those withdrawals if it's made before the 59.5. So missing that 60-day window on an indirect rollover looks a lot like cashing out. And honestly, you'll lose opportunities that you would have gained by doing the direct rollover. So make sure you understand that and think about it. Okay, so as we kind of wrap things up, I just want to call this out. Remember, all of these options that we just talked on, those are choices you make. You leave it where it is, move it to a new plan, convert it to cash, that's that lump sum, or you can roll it to your own IRA. The most important thing we want you to get from today, though, is you need to make an informed decision. With informed decisions, you understand the consequences. But we want to highlight again those consequences. All choices, though, have consequences that you need to be aware of. Cashing out can have, yes, you get that immediate benefit, but there will be long-term costs you'll have that you have to recognize. Some might be enticing at the moment, like cashing out. But again, when you're working on building up your retirement savings, it's important to remember the growth potential of compounding brings over time. And when you need help in rolling over those retirement plan assets, again, I urge you and encourage you to seek financial guidance through a wealth advisor or a financial advisor that you may have. Now let's address some of the OneAZ Wealth Credit Union individuals that are on the call tonight. I want to talk about specifically to them some of the upcoming pension termination issues, okay? First of all, the pension was terminated effective on March the 31st of this year. However, there's lots of calculations and lots of analysis being done. And what will happen is there will be finalization of that and paperwork, as well as letters, and a packet will be created for each individual person, and it'll be personalized. So each individual participating in that pension will get a letter and will get a packet probably in mid to late September. So again, mid to late September is when you should be getting your packet. Now, if for some reason you don't have that packet by October the 1st, I urge you to please reach out to the OneAZ HR department for guidance and direction, and then they'll give you more, perhaps even provide a second copy if it was lost. But very important to recognize it's going to come probably in late September for you. So I'd like to talk about some of the options that you will have that some people might not with other retirement terminations. To summarize those, I've kind of laid them out here in a chart with 5 options. The first one is you can roll over your lump sum of your pension to your OneAZ 401k plan if you're an active, current OneAZ associate. So again, you have to be an active, current OneAZ associate in order to have that rollover option to roll the funds into the 401k plan. The second choice is you can roll the assets to a new employer plan. For example, if you're working somewhere else, who am I talking to here are non-active OneAZ associates. Again, that's focused on non-active OneAZ associates, where you can roll those funds perhaps over into your new employer plan if that plan permits those rollovers. The third option is converting to cash. We've talked about that, taking the lump sum. But again, I urge you, keep in mind the immediate tax liabilities and concerns with that option. The fourth option is you can roll the assets over to your own personal IRA. That actually can provide lots of flexibility, lots of choices, more tailored to your specific needs and desires. And you actually have a fifth option too. Since it's a pension, and remember the pension was designed to provide a guaranteed long-term lifetime income stream for those participants, you can actually retain it. You can retain it for that annuity distribution plan. provide you with that lifetime income of payments that the pension was originally designed to do. Now, let's talk about that fifth option a little bit more. If your desire is to actually retain a guaranteed monthly payout income, that kind of strategy, you should carefully evaluate and consider the three options that I've laid out here. One option you'll have is you can leave it with the principal group, and they're going to spell out and offer their payout option strategies. They're going to be very good and they'll be very sound. You want to look at those and understand those are one of your options. But there is a second option. You could roll over those funds to a different annuity provider, and those different annuity providers actually may offer different annuity income options, as well as beneficiary benefits that may be more desirable to you. So again, you're not locked in, you have choices. The third one is, if you actually plan to annuitize, you might want to think about a strategy called the pension maximization strategy. Again, that's a unique strategy, and I have a slide I want to talk more detail on that. All right, the pension maximization strategy concept has been around a long time. However, it does require some careful understanding and planning of the process. With the pension max method, you are actually designing and managing and controlling your income and the benefits that may or may not be left to your beneficiaries. It actually can be very effective if your age and your health are good, because you can use insurance to provide the tax-free benefits. I said that correct. Tax-free benefits to your beneficiary. Plus there's cash options. Here's a simple example. Suppose your income payout options are $1,000 a month for a single life. Or you could select the $800 a month option for a joint life. That will provide an income for your designated beneficiary when you pass on. When you use the pension max method, you actually select the single life option, but you need to also purchase a pension life policy so for those beneficiaries. So those beneficiaries will have a monthly payout difference. I mean, you're using the $200 a month difference between the $1,000 and the $800. You'll use that to purchase that pension life policy. That's the difference between the single and the joint life. It's that pension life policy that actually provides the tax-free death benefits to the beneficiary, and they can use the proceeds to generate tax-free income as desired. They may not even need all the cash proceeds, so the excess can actually be enjoyed or even passed along to future heirs as well. If beneficiary, now here's a catch, not a catch, this is another perk, is that if the beneficiary predeceases the owner may wish to cancel the pension life policy and enjoy the balance of that higher single life income of that $1,000, for example, and then get a cash refund of any of the benefits inside that pension life policy. Now, I know it sounds complicated. This strategy does require careful planning and insurability by the owner. Depending upon the difference between the ages of the owner and the beneficiary, it may or may not even be financially feasible to self-insure with the pension life policy strategy. But again, I've seen this work over many, many times over the years. It can be extremely beneficial and powerful if done right. But again, I urge you to please consult with your advisor for suitability as well as feasibility on that strategy. It can be very beneficial. All right, let's wrap it up. I'll tell you what, we have lots of questions that have come in, and I want to answer some of those questions as they're coming in right now. And I've got Mike, you're on the line. So Mike, you're going to answer some of these as well. Okay.
All right.
First question we had that came in is, I started a 401k and changed jobs, and my job does not offer a 401k. What now?
Well, it's kind of like what we were talking about earlier. There's the
Mhm.
4 different options, except you don't have one option of rolling it over to a new employer plan. But you can leave your 401k where it is at your old employer. You can roll it over into an IRA, and then you can invest it in the universe of the different investments out there. Uh, or you could cash it in and pay taxes and fees. And uh, my suggestion would be to roll it over into an IRA, because then you'll have complete control over it. You'll have more investment options usually than what you would have in the 401k. And then you can contribute up to it's $6,500 a year in the traditional IRA. And if you're over 50, you can do another 1,000, which is $7,500, would be the maximum you can contribute in that individual retirement IRA, and that would be tax deductible on your taxes.
Mike, why don't we touch on this, because it wasn't covered in the slides, but actually there is a nice perk by rolling it into an IRA. You call it a transfer IRA, right? That they could, if they went to work for another employer that had a 401k plan, they could roll that over into that 401k plan in the future. Is that right?
Yes. So when you roll it over to what they call a rollover IRA, you maintain that status where you can roll it over to another employer's plan in the future. So as long as you keep it as a rollover IRA and you don't start making contributions, you can again roll that over into other plans and keep it as a rollover IRA. Once you start making contributions, you lose that availability, that option to roll it over.
Yep. Now, again, we have lots of questions we're going to go through, but I again urge any of you, if you have a question that we don't get to tonight, please email those into us at oneazwealth@oneazcu.com, and we'll be sure to follow up and address them with you. All right, here's a number 2 question. How to optimize what 401k dollars I have? How do I do that, Mike?
Well, I don't know what they mean by, I don't know if basically when we invest, everyone's trying to do kind of the same thing. We're trying to get the highest possible return with the lowest possible risk. So what we do is we determine people's risk tolerance, how much they can stomach fluctuation, and their time horizon. So the longer the time horizon, the more aggressive you can be. So if you have 401k dollars in the plan, they give you different investment options depending on your objective and your time horizon. They'll offer different options. The rule of thumb is the closer you are to getting to using the money, the more conservative you want to go. So when you're younger, people are more aggressive. As you get closer to retirement, that's when they become a little bit more conservative. So, the reality is if you roll it over, I'm not sure if this person still has the money at an existing 401k, but that's why if that's the case, they can only choose those choices in their 401k. And if they roll it over, they need to see an advisor to discuss their options.
Yeah. And actually, the next question kind of goes a little bit with that. The benefits of rolling over all 401k IRAs to one company to manage. Well, I just share with this a true life story. I know of a case that I worked on, was an individual that actually had 5 different 401ks from former companies, and they had not paid any attention to them. And they've just kind of been left alone. And long story short is they were confused. They didn't know exactly what they had, and it was confusing in their planning process. So again, urging you to really take a look. If you're a good record keeper, great. But many of us like simplicity. So rolling it all over into one and having it overseen and managed could be a little bit better for you. You could get also some benefits and costs. You could get some break points. You could get some just knowing where things are and better organizing your asset allocation if you had it all in one place too. So that's a good call out. Here's a question, Mike. You touched on it earlier, but I think it's worth mentioning again. The question is, what are an IRA and CD?
Okay, yes, I mentioned this a little earlier. An IRA stands for individual retirement account. It is a type of an account that grows tax deferred. You can deduct your contributions and then you'll pay taxes later. Inside of the IRA, you have all these different investment options. One of the investment options is a certificate of deposit or a CD. So a CD is a type of an investment. It's not a type of an account. And you can purchase a CD in a joint name or a non-retirement account at the credit union or at the banks, where an IRA is the actual account, where if you said, hey, I want a guarantee, a fixed rate guarantee, then you can invest in a CD inside of your IRA. That will continue to grow tax deferred, and you're not supposed to touch it to your 59.5. But inside that IRA, a CD is just one of the investment options.
Yep. There you go. All right. Another question is, and actually, before I ask this question, we did receive a lot of questions that were very personal in nature, and for confidentiality, we're not going to ask those questions, and they really need a little bit more information in order to answer them correctly. But here's one I think we can try to answer, Mike. What should I do with my Arizona deferred comp? I am retiring soon, but I am 48 years old. Wow. Okay.
I think they're referring to, we deal with a lot of the state employees here at the credit union. They have what they call a 457 plan, which is similar to a 401k plan, but it's for government employees. So they call that deferred comp. So you can leave the funds again with deferred comp. The one for the state of Arizona is managed by Nationwide, or you can roll it over to an IRA. You obviously, I don't think you want to take the money out and pay taxes on it. And if you're retiring, you're not going to have another employer plan to roll it over into. But the rule of 55, which I touched on earlier, will allow you to access the funds at age 55 instead of age 59.5, as it was with the IRA minimum ages. So you might want to consider leaving it with deferred comp, so you get at that those assets at age 55 without paying that 10% penalty. So the other option is you could roll it over into an IRA and invest in something that will provide you a lifetime income. We have plenty of investments that will give you a guaranteed growth during the accumulation phase. And then when you're ready, you can turn on a lifetime income. It's like your own personal pension. So
Sure.
A lot of it's going to depend on when you plan on actually starting income. And again, what's your risk tolerance and what's your time horizon.
Yep. Okay, we've got about 5-6 more minutes left, Mike. So here's another question. The ways for saving for retirement in a private sector job.
Well, I mean, if they're referring to not having an employer-sponsored plan, what people will do is they will contribute to an IRA. The IRA, you can contribute $6,500 a year, is what it is for 2023. If you're over 50, they give you an extra $1,000 catch-up. So that money in a traditional IRA is tax deductible on your taxes, and it grows tax deferred. If you are, self-employed or business owner, they have what they call solo 401ks. We do what they call SEP IRAs for people, which will allow you to contribute up to 25% of your income. The max this year is $66,000, and that would be deductible. So the advantage of the 401k many times is that most of the time the company will match something. So you might not get that match, if it's a private sector or if you're self-employed. But if you can go into, a SEP or some of these other options, you can contribute much more than just what a traditional IRA of $6,500 is.
Excellent. Okay, here's another question. If I retire mid-year, does the 21,000 limit prorate for the remaining months? Or can I still make 21K for the 6 months? I think he's talking about the 401k limit, right? Last year.
Yes, so that was last year. So this year, the 401k limit is 22,500. Last year, it was 21,000. So you can't contribute more than what you make. So if you've made the $21,000 by mid-year, you can contribute all of that to your 401k, even though you only worked half the year. If you worked half the year and only made $15,000, you can't contribute $21,000. The max you could do is what you made. So this year, real quick, the max for the 401k, 457, 403b is $22,500. And if you're over 50, you can do an extra $7,500. So if you're over 50, you could contribute up to $30,000 this year in your retirement plan.
Yeah, excellent, excellent. Okay, here's an interesting one. It appears that they want to increase money moving forward to make sure I don't run out of money in my old age, 93. Wow.
Okay. Well, there's a lot of people out there that are afraid of outliving their money. They're just going to live so long and run out of money. So your pensions are basically annuities. You can get your own annuity and it will give you some guaranteed growth. And when you get ready to start income, it will give you a lifetime withdrawal or a lifetime income that you cannot outlive. And as we talked earlier, you can decide if you want to do it for your life. You can do it for a joint life for your beneficiaries. But that is probably the best way to guarantee, regardless of what happens in the stock market or the economy or whatever, that you can never outlive your money. There's never been an annuity that's failed. So it's kind of like setting up your own pension.
Yep. And that's so true, because what we've done, and we see so many individuals, we've accumulated huge amounts of wealth in our 401ks, on our 457s, or our 403bs. And now it comes time to retire. Now we have to start planning what? For the distribution for income. It was accumulation for wealth. Now it has to be a decumulation so that we don't run out of money. That's critically important, folks. And there are strategies that can be carried out and shown to you that can help you through this process. So I urge you to meet with one of our wealth advisors or anyone that is qualified in this area to give you great guidance and explain to you scenarios of how to do it and how to do it well. Because you've saved up a lot of money over a lot of years, and now you have to make some really important decisions. Much like Social Security, you'll have to make some very critical decisions when it comes time for retirement during Social Security. You want to pick the right time and the right options so that you can maximize that benefit that exists there. Okay, Mike, just one more question and then we'll kind of wrap it up. Let's see. You talked about the rule of 55 already. Let's see here. Can I roll my 40? Well, I think they made a typo here, but can I roll over my 403k? There isn't such a thing, but 403k retirement to my bank to invest in a Roth without penalty. So,
well, let's clarify real quick. So there is something called a 403b. So 403b is in boy. So what that is, so a 401k, that stands for IRS section code 401k. A 403b is similar, but it's for not-for-profits. So you'll see a lot of your teachers, schools, nurses, they have a 403b. It's similar to a 401k, grows tax deferred, you pay taxes. And for the government employees, they call it a 457 plan. So yes, if you have a 403b, similar to a 401k, you can roll it over to an IRA, to your bank. And once it's in the IRA, you can convert it to a Roth IRA. But once you convert to a Roth IRA, you will pay taxes on that money that you're converting. So when you're putting money in before taxes out of your paycheck, or you're contributing to an IRA and deducting it off your taxes, you're going to have to pay taxes on that money later. So what the Roth IRA will provide is you'll pay taxes on that money now. Going forward, it will continue to grow tax deferred, and it will all be tax free when you take it out. And lastly, there will be no required minimum distribution when you're 73. So you can do that. I think she's probably referring, or the person's probably referring to a 403b. And yes, just know that when you do convert, there is a taxable event.
Yep. And be careful, because that's they call it bracket creep. Bracket creep is by creeping up the tax brackets and you didn't find out until too late. You don't want to pay higher taxes unnecessarily. So it's really a common practice is
Yes.
to plan, right?
Yeah,
To plan
because
out
we're-
those transitions.
Yeah, I should mention that your IRA distributions, everything we're talking about, that is ordinary income. So it's not taxed like a capital gain or dividends. It's ordinary income. So if you are converting $50,000 from your IRA to a Roth IRA, you're adding $50,000 onto your income, and it might put you in the next tax bracket. And that's what you mean by the creep.
Yeah, the bracket creep.
The bracket creep. Exactly.
Yeah, it's called bracket creep. Okay, let's wrap it up. I want to say thank you, folks. Wow, we've went over a lot of information here, a lot of information about pension election decisions. I want you to understand the OneAZ Wealth team of advisors can be a great source for future education on any and all of these ideas and concepts and strategies outlined in today's presentation. Please take advantage of your complimentary consultation. For you, if you're a member of OneAZ Credit Union, that's what they're here for. For those that are watching and listening, again, thank you for joining. We hope our discussion today has been helpful to provide insights and ideas on rollover ideas, options. We are, again, here at OneAZ Wealth Management. We welcome your feedback and your comments. So please email us with any suggestions you have for future webinar topics. As always, our entire OneAZ Wealth team of advisors stand ready, willing, and able to assist in reviewing your current financial plan and your portfolio in light of today's economy. There's no better time than the present for a second opinion on your current plans. Many of our clients had other advisors when they first came to us, and they learned and discovered new ideas and new strategies that are better suited for their needs. So again, I welcome your call. You can call us at the 800 number that we have, 877-566-0517, or you can visit our oneazwealth.com website for more information in helping create your own wealth plan. Again, thank you for joining us. And I want to close with a wish to all of you for the best of 2023 ahead, for your safety, your health, and your wealth. Thank you and have a great night. Bye-bye.
Good night.